All right, let's talk about the big one, stocks versus real estate. It's the ultimate financial debate, right? For what feels like forever, we've all been told that owning property is the number one undisputed way to build wealth. But is it really? Today, we're going to cut through all that noise and do a real world, head to head comparison from the last 5 years. So let's get into it. I mean, think about it. For as long as any of us can remember, owning property has basically been the American dream, packaged and sold to us. It's tangible, you can touch it, you can see it. It's seen as a huge sign of success. And it's always been pushed as the safest, most reliable way to create that generational wealth everyone talks about. But here's the question we really have to ask ourselves. In the world we live in today, does that long-held belief still hold up when you actually, look at the math? When you put it right up against another really powerful way to build wealth? Okay, so take a look at this. This is where it gets kind of wild. Let's say you bought a house for $300,000 back in 1988. Today, that house might be worth around $1.75 million. That is a fantastic 480% return. Nobody's arguing with that. But what if you took that exact same 300 grand and just put it into a simple S&P 500 index fund instead? Well, it would have grown to an incredible $14 million. That's a 4,500% return. We're talking almost 10 times more money from the stock market. Okay, I get it. A 30-year hypothetical is one thing, but it's a little abstract. So let's bring this down to earth. Let's do a concrete, personal case study comparing real investments made over just the last 5 years. So for any good experiment, you need a baseline, right? A clear yardstick to measure everything against. And for this test, our baseline is going to be one of the simplest, most powerful investments you can make, a stock market index fund. You're basically owning a tiny little slice of all the biggest companies at once. And wow, the performance over these last 5 years, it's been unusually strong. The return has been a clean 100%. That's it. Your money literally doubled. I mean, just let that sink in for a second. Every $100,000 you invested just by putting it there passively grew to $200,000. No tenants to deal with, no leaky faucets, no panicked calls in the middle of the night. So that's the bar. It's simple, it's passive, and honestly, it is tough to beat. All right, so now let's bring in our contenders from the real estate world. And we're not just looking at one property. We're going to look at two very different houses. Each one has its own story, its own numbers, and a very different outcome. So first up, we have a Seattle townhouse that was bought in 2019. Now, this was a pretty low money down deal. It only took about $40,000 to get in the door. Now, compare that to our second property, a house in Palm Springs, bought in 2020. This was a much, much bigger project. It took a whopping $243,000 investment just for the down payment and all the renovations. Okay, let's get to the results for house number one. And this is where things get really, really interesting. That initial $40,000, if it had just gone into the stock market, would have doubled to $80,000. Pretty good. But the return from the Seattle townhouse, after you account for everything, the mortgage, taxes, realtor fees, the net profit was $117,000. So round one, a clear win for real estate. So the property won. But wait a minute, how is that possible? I mean, the house itself didn't appreciate that much more than the stocks did. So how on earth could a smaller investment of $40,000 lead to a bigger overall return? And the answer, in one single word, is leverage. This is the absolute superpower of real estate. See, you're using the bank's money, the mortgage, to buy the asset. So you don't just earn appreciation on your little $40,000 down payment. You earn it on the entire value of the home. That's the magic trick right there. That's what created that outsized return. Okay, now let's look at property number two, the Palm Springs house. Remember, this one started with a much bigger investment, $243,000. Over that same period, if that money had just gone into the stock market, it would have grown to about $422,000. Not bad at all. But the house? After factoring in all its costs and the eventual sale, it pulled in a total profit of just $293,000. So in the second case, yeah, the stock market wasn't just the winner. It won by a massive margin. It absolutely crushed it. You would have made far more money with far less effort by simply investing in an index fund. But, as anyone who has ever owned a rental property can tell you, the numbers you see on a spreadsheet, that's only part of the story. There's this huge hidden cost that we really need to talk about. And I'm talking about the hassle factor, the day-to-day, real-world grind of being a landlord. and that's something your stock portfolio will never, ever ask of you. And hey, don't just take it from me. Listen to a guy like Ryan Pineda. He's a massive real estate investor. He's super upfront about it. He says he expects his rentals to have zero cash flow because he expects that some kind of drama is going to pop up and eat all the profit. And what does that drama look like? Oh, you know exactly what it looks like. It's the late-night calls about a leak. It's the dishwasher that suddenly decides to die. It's dealing with tenant turnover, managing vacancies, rising property taxes. Let's just be honest and call it what it is. For most people, being a landlord is a second job. It is not a passive investment. So where does all this leave us in the long run? Well, for that winning townhouse, the power of leverage really starts to shine over time. In 25 years, that initial 40 grand in stocks might grow to a very respectable $866,000. But the total value of the townhouse, that asset could grow to $2.4 million, creating some really significant equity for the owner. But the story completely flips for the Palm Springs house. That initial investment of $243,000 in stocks, over 25 years, it could compound to over $4.4 million. That would easily beat the house's projected value of around $2.8 million. So after we've run all the numbers and we've weighed the hassle factor, which one is actually the better investment? Well, the honest answer, and I know this might be a little unsatisfying, is that it really depends. It depends entirely on the specific deal. So let's just break it down one last time. With stocks, the pros are that it's truly passive, it's simple, and it has historically strong returns. The main con? No leverage. With real estate, its superpower is leverage, and you get some great tax benefits. But the cons are significant. It is a ton of work, it's illiquid, meaning you can't get your cash out quickly, and it is full of unexpected costs. So the most important thing to take away from all this is this. If you're not out there buying rental properties, it does not automatically mean you're missing out. A simple, maybe even boring, index fund is an incredibly powerful and a dramatically easier way to build serious wealth. And that kind of leaves us with one final question, one that goes way beyond the balance sheet. In the end, what if the best investment isn't the one with the highest potential return? What if the best investment is actually just peace of mind?